People don't usually wake up in the morning and say, "Today, I will trust a new form of money created by anonymous code." Instead, what we often hear sounds more like suspicion, curiosity mixed with doubt, and a sense of caution born from too many financial scams in modern history. It's almost impossible to talk about Bitcoin without encountering the same question over and over. Isn't Bitcoin just a Ponzi scheme? The phrasing varies. It's just speculation. It only rises when new people buy. It's a bubble waiting to burst. But the fear behind it is real, and it deserves a serious, thoughtful answer, not just evangelism or hype. To understand why this perception exists, we need to look at the world people grew up in. For decades, society has been shaped by stories of fraud and collapse. Bernard Madoff's infamous investment fraud, countless MLM schemes, flashy crypto projects that promised guaranteed returns and then disappeared overnight. Even traditional banking systems have at times betrayed trust, from hyperinflation wiping out savings to governments freezing accounts in times of crisis. When someone first hears about Bitcoin, digital money without a bank, no CEO, no office, no one in charge, the instinctive reaction is often defensive. If no one controls it, then who protects me? And if people make money when more buyers enter, isn't that exactly how Ponzi schemes work? But before we go further, let's outline what a Ponzi scheme really is, not in textbook form, but in spirit. A Ponzi scheme relies on a central operator who promises profits, often consistently high profits, to investors. Instead of generating real revenue, the profit given to early investors comes from money contributed by later investors. There is no actual business, no underlying value creation, no product or service. The house of cards stands only as long as money keeps flowing in. When it stops, the scheme collapses, and most people lose everything. That's the core of it. A Ponzi requires deception, promises, and dependence on endless recruitment. Now bring Bitcoin into the picture. Why do some people think it fits that description? Because from the outside, they see price volatility and speculation. They see early adopters becoming wealthy as later participants join. They see influencers promoting it, evangelists tweeting about buying the dip, and news headlines screaming either euphoria or panic. They witness the rise and fall of altcoins, meme tokens, and fraudulent projects labeled as crypto, even when they have nothing to do with Bitcoin's decentralized foundation. It becomes easy to lump everything together, to assume that if the price goes up when more people buy, it must be the same old game. The early ones profit, the late ones pay. This misunderstanding is rooted in surface-level observation, not a deep understanding of how Bitcoin actually works. It's emotional rather than technical. When a technology is invisible to the senses, you can't hold a Bitcoin like a banknote or bar of gold. The brain fills the gap with analogy, and analogies often fail. People compare Bitcoin to what they know, and unfortunately, many know Ponzi schemes far better than they know decentralized monetary systems. Still, the doubt is not unreasonable. Healthy skepticism is a good starting point, especially with money. If someone asked you to put value into something intangible created by anonymous developers, without government backing, and with a history filled with dramatic price swings, wouldn't you hesitate too? Skepticism is not a sign of ignorance. It's a sign that people care about protecting what they've earned. The problem arises only when skepticism stops at the headline instead of looking deeper. So the real question we must ask is not, why do people call Bitcoin a Ponzi, but does Bitcoin actually function like one? And if it doesn't, what makes it fundamentally different? Before answering that, let's acknowledge an uncomfortable truth. Many people who lost money in crypto didn't lose it to Bitcoin itself, but to scams built around it, centralized exchanges that collapsed, tokens promising unrealistic returns, pyramid-style referral systems disguised as investment platforms. These failures cast long shadows. To someone outside the space, scams and Bitcoin appear inseparable, even though they are structurally opposite. Bitcoin does not ask for your trust. It asks you to verify. It does not promise profit. Price moves freely according to supply and demand. It does not have a founder collecting funds or distributing dividends. Satoshi Nakamoto disappeared, leaving no central authority to pay or persuade anyone. Yet the confusion persists because, psychologically, people connect the emotional experience of loss with the symbol of Bitcoin itself. And yet, despite all skepticism, Despite every crash and every obituary written about it, Bitcoin refuses to disappear. It has survived more than a decade of opposition from banks, governments, economists, and the media. It has crashed spectacularly and risen again. It has been banned in some countries, embraced in others, and adopted by millions of ordinary people across the world. It continues to function every 10 minutes, block after block, without needing permission from any institution. Ponzi schemes do not survive market cycles, public attacks, and technological scrutiny. Ponzi schemes collapse in silence. Bitcoin grows louder. So we return to the question with which we started. Why isn't Bitcoin a Ponzi scheme? The first answer lies not in price charts, but in structure. A Ponzi is built on promises from someone in power. Bitcoin is built on code, consensus, and mathematics. A Ponzi collapses when new investors stop joining. Bitcoin continues to exist even when nobody buys, because it is a network, not a payout machine. A Ponzi requires trust in a leader. Bitcoin removes the leader from the equation entirely. But to fully understand this difference, we must go beyond analogies and dive into the mechanics of how Bitcoin operates, how miners secure the network, where new coins come from, why its supply is limited, and why transparency is its greatest weapon against fraud. That's where we're heading next. To understand why Bitcoin is fundamentally not a Ponzi scheme, we need to strip away the emotions around price charts and step inside its engine room, the mechanics, the incentives, and the architecture that keeps it alive. If a Ponzi scheme is like a charismatic salesman promising riches with no real product behind him, Bitcoin is the opposite. A system with no salesman at all, yet millions willingly participate because the product is the system itself. Nobody stands on a podium guaranteeing high yields. No central figure collects money from newcomers. There is no hotline you can call to demand returns. Bitcoin doesn't whisper promises, it simply exists. Start at the beginning. When Satoshi Nakamoto released the Bitcoin white paper in 2008 and launched the network in January 2009, there was no fundraising, no token sale, no invitation to invest and earn interest. The code was open. Anyone could run it, and the first Bitcoins had no market value at all. In fact, for a long time, people mined Bitcoin on ordinary computers just for curiosity, trading thousands of coins for pizza or giving them away online. No one was paying old users with the money of new users, because there was no money to begin with. It was innovation, not investment, that pulled people in. A Ponzi scheme relies on a central operator who takes money from newcomers and redistributes it. Bitcoin has no operator. If you buy Bitcoin, you don't send money to Satoshi or a company promising to multiply it. You buy it from another participant, just like exchanging dollars for euros or gold for cash. You're not joining a program. You're entering a free market. There is no central wallet collecting deposits, no headquarters storing funds, no backstage accountant balancing inflows and outflows. All coins are recorded on the blockchain, publicly visible to anyone on Earth. Nothing could be more different from a Ponzi, which thrives in secrecy and opacity. Let's talk about miners, a concept often misunderstood. Some critics simplify mining as new people pay old people, but that misses the core mechanism. Miners don't earn Bitcoin from investors. They earn Bitcoin as a reward for providing computing power to secure the network. They solve cryptographic puzzles, validate transactions, and ensure no one can cheat the ledger. It's work, measurable, verifiable work. You can see it, audit it, and compete with it. A Bitcoin reward is not interest. It's payment for maintaining a global infrastructure. A Ponzi has no such mechanism. It does not produce security, energy expenditure, or computational effort. Bitcoin, on the other hand, consumes massive energy because it anchors trust not in people, but in mathematics and physics. Transparency is another key difference. In a Ponzi, you never really know where your money goes. In Bitcoin, every coin ever created is trackable on-chain from the Genesis block to today. Anyone, not only regulators or insiders, can open a blockchain explorer and verify supply, transactions, holdings, and mining rewards. You don't need permission to verify the truth. The system is trustless, not because you must trust no one, but because you don't need to trust anyone. That is the beauty and the irony. Bitcoin earns trust by not requiring it. Another essential distinction lies in incentives. Ponzi schemes lure participants with guaranteed returns, often smooth, stable, and unrealistically positive. 10% per month, 20% per quarter. Risk-free profits. That is the bait. Bitcoin offers no guarantees. Its price rises and falls. It crashes violently. It tests conviction. It rewards patience only historically, not by contract. If you want certainty, Bitcoin is not the place to find it. Its volatility is not a flaw. It is evidence that Bitcoin does not engineer its market to deceive anyone. A Ponzi must appear stable to remain attractive. Bitcoin embraces chaos because price is simply supply meeting demand in the open. Critics often argue, but early adopters get rich as more people join. Isn't that Ponzi-like? At first glance, yes, the early ones had an advantage. But advantage isn't fraud. Early owners of Apple stock became wealthy too. Early internet entrepreneurs captured enormous value. Early gold prospectors found nuggets lying in rivers, while later miners dug miles underground. Innovation rewards early risk takers. That alone doesn't make something a scam. In a Ponzi, early participants profit only if new victims keep arriving. In Bitcoin, early holders benefit if demand grows, but not because Bitcoin drains wealth from newcomers. It's because the market collectively prices Bitcoin higher as more people recognize its scarcity and utility. Early ownership in a deflationary asset isn't exploitation, it's economics. Consider what happens if nobody new buys Bitcoin. Does the system collapse overnight like a Ponzi? No. Blocks will still be mined, transactions will still be validated, coins will still be sent globally without permission. The network continues to operate because it does not depend on new money to pay anyone. Miners are paid by the protocol itself through a diminishing block reward, not through recruitment. Users hold Bitcoin because they choose to, not because someone owes them a payout. If demand drops, price falls, but the system lives on. A Ponzi dies the moment the inflow stops. Bitcoin keeps breathing. All of this leads to one clear reality. Bitcoin is a monetary network, not an investment product. It does not promise profit, it does not pay yield, and it does not rely on deception. It stands or falls on adoption, transparency, mathematics, and open competition. Its value is discovered, not distributed. But if its structure is so different, then where does Bitcoin's value truly come from? Why do millions believe in it? What gives digital coins meaning in a world already full of currencies? To answer that, we must explore the roots of value itself: scarcity, utility, and the human desire for financial sovereignty. That's where we go next. Value is a mysterious thing. We give value to pieces of paper with government seals. We give value to digits inside a bank account that we never see physically. We give immense value to gold, shiny metal that sits quietly in vaults for decades without producing income or providing utility beyond cultural belief and industrial use. Humans decide what matters. Value is a social contract, an agreement, a collective belief. So when someone asks, why does Bitcoin have value? The answer isn't found in a lab or factory. It begins with the same fundamental principle that underlies all forms of money. We value something when enough people believe it is useful, scarce, and trustworthy. Bitcoin didn't invent that rule. It simply applied it in the digital realm. Start with scarcity. Unlike fiat currencies, which governments can print indefinitely, Bitcoin has a fixed supply of 21 million coins. That limit is hard-coded into the protocol. No politician can change it. No CEO can decide to mint more. Every 4 years, the issuance rate is cut in half, a process called the halving, making new coins increasingly rare. If gold models scarcity through geology, Bitcoin models scarcity through cryptography and game theory. In a world where printing money is as easy as striking a keyboard, Bitcoin is an antidote to inflation by design. Scarcity, however, is meaningless without utility. Diamonds are rare, but people don't trade groceries in diamonds. Scarcity alone doesn't create money. Usefulness does. Bitcoin's utility lies in being borderless digital cash. Anyone can send it anywhere in the world, at any time, without asking permission. There is no bank to approve a transaction, no closing time, no frozen account because of a bureaucratic error. For someone living in a stable economy, that might sound like a luxury feature. But for people in countries with hyperinflation, capital control, or political instability, Bitcoin is not speculation. It is survival. Imagine waking up to news that your currency has lost half its value. Imagine being told you cannot withdraw your own money from the bank. Imagine living under a regime where sending money abroad is illegal or dangerous. For millions of people, this isn't imagination. It is daily reality. In places like Venezuela, Argentina, Nigeria, and Turkey, Bitcoin became a lifeline. Not because someone promised profit, but because it gave citizens a way to protect what they earned. In these environments, Bitcoin isn't competing with stocks or bonds, it's competing with chaos. But let's zoom out beyond financial crisis. Bitcoin's value also comes from trustless verification. The idea that you don't need to trust a bank, a government, or even another person to know your money is yours. You hold your own keys. You validate your own transactions. The network verifies every block without bias or corruption because rules apply equally to everyone. This is the first time in history humans have had a form of money that doesn't rely on centralized authority to function. That alone is revolutionary. Then there is security. Bitcoin's network is one of the most secure computational structures ever created. To rewrite its history, an attacker would need unimaginable amounts of energy and hardware. The cost of cheating exceeds the benefit. In traditional finance, trust is enforced by courts and police. In Bitcoin, trust is enforced by physics, cryptography, and economic incentives. That's value, not imaginary, not theoretical, but engineered. Some critics say Bitcoin has no intrinsic value. Yet, what is intrinsic value, really? A dollar bill has paper and ink? Is that its value? Gold has atomic structure and shine. Is that why it stores centuries of wealth? Or is their value born from shared belief, scarcity, durability, and utility as a medium of exchange? If the latter is true, Bitcoin fits the definition of money as much as anything humanity has used before. Bitcoin also has cultural value. It represents an idea, the idea that money can be independent from state control, that individuals can own wealth in pure digital form, that value doesn't need a physical container. For some, Bitcoin is technology. For others, it's a movement. For many, it's hope that the rules of money can be fairer. This ideological layer is one reason the network keeps growing even through bear markets. People don't join because someone promised them returns. They join because it solves a problem they care about: inflation, censorship, financial exclusion, or simply the desire for sovereignty. And sovereignty leads us to one more dimension of value: time. When you hold Bitcoin, you're making a statement that your future self deserves protection. You're converting present energy into durable digital form, one that cannot be diluted or seized easily. In that sense, Bitcoin is not just money. It is a time capsule for wealth. So if Bitcoin is scarce, useful, verifiable, secure, borderless, and culturally meaningful, does that sound like a Ponzi scheme? Ponzi schemes produce nothing. Bitcoin produces a global payment network, a digital store of value, and a new economic paradigm. But skepticism remains, and rightfully so. Critics still argue that Bitcoin rewards early adopters disproportionately. They point to price bubbles and speculative mania. They warn that people can lose money, and they're right. Bitcoin is volatile. It's young. It demands responsibility and understanding. But volatility is not fraud. Risk is not deception. Growth is not exploitation. To settle the debate fully, we must now compare Bitcoin directly with real Ponzi structures, not emotionally, but structurally, and dismantle the common misconceptions one by one. Only then does the contrast become unmistakable. That is where we go next. There's a moment when skepticism turns into clarity, usually when someone stops arguing about price and starts examining structure. Because the deeper you examine Bitcoin, the less it resembles a Ponzi scheme, and the more it resembles something we've never had before: a monetary network that runs without rulers. To make this distinction undeniable, let's contrast Bitcoin with real Ponzi schemes, not philosophically, but mechanically. A Ponzi scheme has a mastermind, someone at the top, someone collecting funds, managing deposits, promising returns. This person needs to attract new investors to pay earlier ones, or the machine dies. Bitcoin, in contrast, has no leader. Satoshi vanished. There's no office, no hotline, no quarterly earnings report. There is software maintained by a decentralized community of developers, miners, and users spread across the globe. No single person or entity controls it. No one receives deposits or redistributes profits. In a Ponzi, centralization is a feature. In Bitcoin, decentralization is the foundation. A Ponzi offers guarantees. It seduces with certainty. Earn 20% monthly. Double your money in 90 days. Risk-free returns. This is the bait that hooks the unsuspecting. Bitcoin offers no such promises. Instead, it gives freedom, volatility, responsibility. Bitcoin's price can soar or crash without warning. It demands understanding. If you expect guaranteed profits, Bitcoin is a terrible choice. If you value sovereignty and long-term scarcity, it becomes something else entirely. A Ponzi thrives on smooth predictability. Bitcoin is unpredictable because it is real. Then there's liquidity. When a Ponzi collapses, withdrawals freeze. Investors are locked out, the mastermind disappears, and funds evaporate. Bitcoin, on the other hand, doesn't stop working when sentiment turns negative. It doesn't go offline during bear markets. The protocol continues producing blocks every 10 minutes, whether the price is $60,000 or $6,000. Even in major crashes, and there have been many, the network never paused. Transactions continued. Miners mined. The ledger remained intact. A Ponzi needs constant fundraising to survive. Bitcoin needs no one's permission to exist. Some critics insist, but early adopters get rich, and newcomers buy in hoping price rises. Isn't that Ponzi-like? Let's dissect that. Early participants in any scarce asset benefit if demand increases. Early stockholders of Amazon got rich. Early holders of rare art got rich. Early owners of beachfront land got rich. That dynamic is not fraud. It is simply how markets reward early risk. In a Ponzi, early winners profit directly from later entrants' deposits. In Bitcoin, if the price rises, early holders profit because the market reevaluated the asset as valuable, not because Bitcoin pays them from someone else's investment. No entity distributes returns. Gains, when they occur, come from open market price discovery, not from a central operator. Another argument we hear often: Bitcoin has no value. It's just speculation. But speculation exists because people recognize potential. Before the internet became part of everyday life, investing in internet companies was pure speculation. Before electricity lit cities, backing electrical grids was speculation. Speculation is not inherently negative. It is the early stage of value discovery. Over time, as infrastructure grows and adoption deepens, speculation transforms into recognized utility. Bitcoin is following that path, from curiosity to commodity to potentially global monetary layer. Critics also point to volatility as evidence of fraud. But volatility is not a symptom of Ponzi behavior. It is a symptom of a young asset finding its place in the world. Gold was volatile for centuries before becoming stable. Fiat currencies crash violently when governments mismanage them. Housing markets boom and bust. Volatility is simply the price we pay for freedom from central control. A steady upward curve is the sign of a Ponzi, not the sign of a free market. Another misconception: Bitcoin needs new buyers to stay valuable. But everything needs market demand to stay valuable. Real estate, stocks, art, even gold. If nobody wants a Picasso, its price falls. If no one buys Tesla stock, it crashes. Demand is not a Ponzi characteristic. The source of payout is. Bitcoin pays no one. It distributes nothing. There are no promised returns. People hold it voluntarily because they believe in its properties, not because someone is contractually obligated to enrich them. And here's a striking truth. Bitcoin has survived waves of negative press, government hostility, exchange collapses, bear markets, and the disappearance of its creator, and yet it still stands. Ponzi schemes implode under pressure. Bitcoin matures. Each market crash clears speculation and reinforces the network's core. Each cycle draws more long-term thinkers, more developers, more infrastructure, more global integration. A scam fades into history. Bitcoin keeps writing new chapters. Even governments and institutions once hostile now participate. Countries hold Bitcoin in reserves. Public companies add it to balance sheets. Financial giants offer Bitcoin custody and trading. Universities teach blockchain engineering. Developers continue to strengthen privacy, scalability, usability. A Ponzi cannot attract the world's brightest engineers. It cannot power global payment settlements. It cannot inspire a generation to learn cryptography just to own their financial freedom. Real Ponzi schemes rely on secrecy. Bitcoin is the most transparent monetary system ever created. Real Ponzi schemes fear audits. Bitcoin is an audit, forever open, permanent, immutable. Real Ponzi schemes crumble without trust. Bitcoin removes trust from the equation. So when someone asks if Bitcoin is a Ponzi scheme, they're really asking a deeper question. How can something without a CEO, without a company, without guaranteed returns, still thrive? The answer lies not only in structure, but in meaning. Bitcoin isn't just software. It's a shift in how we think about ownership, money, and freedom. And that's where the heart of the story becomes personal. Because behind every Bitcoin holder, there is a reason, sometimes logical, sometimes emotional, often transformative. The final piece of this script isn't about charts or protocols. It's about what Bitcoin feels like when you stop seeing it as speculation and start seeing it as self sovereignty. Now, let me take you there, not as an analyst, but as a person. When I first heard of Bitcoin, I didn't understand it. In fact, I dismissed it, like many people do, as internet money for tech geeks, gamblers, and dreamers. The headlines painted it as a bubble. Friends called it a scam. My instinct was to stay away. But there was this quiet curiosity beneath the skepticism, a voice that kept asking, if this thing is worthless, why hasn't it died yet? Why do some people speak of it with such conviction, almost reverence? So I did what skepticism is supposed to inspire. I started learning, not rushing in, not buying impulsively, just reading. I read the white paper. I watched discussions by economists, cryptographers, developers. I listened to people who loved Bitcoin, and more importantly, to people who hated it. Over time, something shifted. The narrative that once sounded like hype began to sound like a response to a deeper problem, a problem I hadn't fully acknowledged before. We live in a world where we must constantly trust, even when trust has been broken repeatedly. I thought about savings accounts that lose value silently through inflation. I thought about governments printing money to solve political problems, with citizens paying the price unknowingly. I thought about how fragile ownership actually is when it exists only as numbers in a bank's database that can be frozen, limited, or erased. For the first time, I realized that Bitcoin wasn't trying to replace money because money is bad. It was offering an alternative for when money fails. And history shows that sooner or later, traditional money always fails somewhere. The more I learned, the more personal it became. Bitcoin was no longer just code. It was a door to a world where I could hold value without permission, a world where my wealth wasn't someone else's liability, a world where financial power moved from institutions to individuals. That realization didn't make me rich, it made me aware. And awareness is more valuable than profit. Holding Bitcoin felt different from holding stocks or real estate. You don't receive dividends. You don't get rental yields. What you receive is responsibility. If you lose your keys, nobody saves you. If you make impulsive decisions, the market teaches you quickly. Bitcoin doesn't reward ignorance. It rewards patience, understanding, self-control, qualities that traditional finance rarely demands from you. In a strange way, Bitcoin felt like a mirror. It didn't just store value, it revealed mine. It made me think longer term. It made me ask what money really is, not just a tool to spend, but a tool to protect time, effort, and dreams. Every hour of work is a piece of life exchanged. When money loses value, life loses value. Bitcoin, to me, became a way to preserve that piece of life. Not perfectly, not without risk, but with intention. There were moments of doubt, price crashes that shook my confidence, articles claiming Bitcoin was doomed, people saying I was foolish to believe in something so volatile. And maybe I would have quit if Bitcoin were just an investment. But it had already become something more, a lesson in discipline, a reminder that meaningful things are rarely comfortable at first, a challenge to think independently rather than follow the noise. Over time, I met people who felt the same, developers who contributed code because they believed in a free monetary future, immigrants who sent Bitcoin across borders when banks blocked transfers, young people buying tiny amounts because they trusted mathematics more than financial headlines, quiet holders who never boast, never shout, but simply accumulate with conviction, not because they expect instant riches, but because they believe money should not rely on permission to exist. For me, that belief is powerful. It's not ideological fanaticism, it's personal. Bitcoin became the first asset where I felt ownership in the truest sense, not ownership granted by a bank, but ownership I can prove cryptographically. It made me think about freedom, about resilience, about who controls the future of value. Does Bitcoin guarantee wealth? No. Does it eliminate risk? Absolutely not. Is it perfect? Of course not. But neither was the internet in 1995. Neither was electricity in 1882. New technology is messy before it becomes obvious. Bitcoin is still young, still evolving, still misunderstood. Yet, despite all obstacles, it continues to grow. not because someone promises returns, but because millions of individuals choose it voluntarily. A Ponzi scheme feeds on trust until the trust runs out. Bitcoin grows through skepticism, questioning, debate, and adoption built not on promises, but on proof. The difference is profound. Bitcoin doesn't ask you to believe, it invites you to verify. Why isn't Bitcoin a Ponzi scheme? For me, the answer is simple now, because nothing in a Ponzi scheme teaches you responsibility, sovereignty, patience, or freedom. A Ponzi collapses when hope ends. Bitcoin survives because hope isn't what holds it together. Truth is. And after years of watching, reading, learning, holding, sometimes doubting, sometimes smiling, I've come to my own quiet conclusion. Bitcoin is more than an asset. It's a statement, a vote for a different future, a belief that money should serve people, not rule them. And whether one owns a lot, a little, or none at all, I think understanding Bitcoin is one of the most profound financial experiences of the modern world. Not because it promises to make you rich, but because it challenges you to think about what it means to be truly in control of your wealth. That's why, for me, Bitcoin isn't a Ponzi scheme. It's a possibility, one I'm grateful I didn't ignore.